Good morning and welcome to Momentum Global Matters. My name is Ray Mere and I'm Head of Investment Distribution here at Momentum. With me in studio is my colleague, Kapil Joshi, who's the Head of Momentum Collective Investment Schemes. So Kapil, what do you think of our new three-dimensional studio here?
I think it's amazing, and I love how Momentum Investments has embraced the future with our events in the last 12 months. For all of you watching at home, let me tell you a little secret. None of this is real. Not the plants, not the couches, not the walls, the floors, or the ceilings. Ray, should we show them where we really are?
Why not? For everybody tuned in today, we have an incredible lineup of investment experts from around the world who will be sharing their insights and views about the past 12 months and also the road ahead.
But before we get to our first speaker, just a few things for all of you to note. Not only did we build our new beautiful virtual studio, we thought it also needed a home. You're watching this from our brand new Momentum Investments events website. This website has a couple of really neat features. At the top of the landing page, you will see that we give you access to our agenda, profiles for each of our speakers, and a great way to navigate this conference.
In addition to that, our download section has links to all the presentations, information packs from all our presenters, and links to video content you might find interesting. As we move into the future, this website will continue to grow and become your home for investment information. Our investment specialists are on hand to answer any questions you may have during the event, so please post your questions in the chat box for us to respond to them. If you need any more information regarding our capabilities or investment solutions, please request a callback and we'll get back to you as soon as possible. Kapil, shall we get the show on the road?
Let's do that.
Joining us in studio is Jeanette Marais, who is the Chief Executive Officer of Momentum Investments. She's going to talk about our business and how the world has become a truly global village.
Thank you, Ray. I am privileged to welcome you to our annual Global Matters 2021 event. It's always a privilege to have you join us at our conferences. A year ago, most of us still thought that COVID-19 would soon be a thing of the past. But what an effect it had on the global economy and on each of us, from the way we work and engage to how we see the world. Zoom became a verb, and you're on mute, something you hear every day. Dressing up for the office sometimes meant fancy on top with jeans and sneakers below the screen. Virtual conferences allowed for more inclusion, and more than 700 delegates from all over the world participated in MGIM's first virtual think tank last year. While we all long to get back to human contact, we know that even once COVID-19 has left us, the world will continue to work in new and innovative ways. We pride ourselves on always keeping our finger on the pulse of the way the world is moving, and so we welcome you to this very first broadcast in our own brand new virtual studio. If the last year has taught us anything, it is that innovation and incredible ideas are truly going to be the wave of our future. For us, investing is personal. We've engaged with you in the past year and also conducted research about human behavior in difficult times, which the COVID-19 pandemic and the market crash in 2020 certainly were. Asking the right questions is just as important as giving the correct advice. We will be asking and addressing some of those critical questions in the discussions today. You will hear about the markets, get an overview of financial planning and advice, how to choose global partners, and hear about our behavioral research on advice, noise, and blind spots. We are very grateful that in a time where some businesses had to close their doors, we have business results that we are proud of. And on top of that, we have more supporting advisors than ever before in our history. On that note, I want to thank all of you, our partners and advisors, attending the event today and who have been and still are supporting us. Without you, we will not be able to provide the personal solutions to our clients, our reason for being. Our goal is to help advisors in their practices, not only as a business that provides a platform or as an investment manager, but as a true partner to advisors and to your businesses. What is deemed as professional has changed. COVID-19 encouraged us and demanded us to shift our focus to softer issues. Often, we focus so much on being professional that we forgot to be authentic and real. We had to put ourselves in the shoes of our clients. We had to become personal and even vulnerable. This has changed our future approach to dealing with clients for the better. Being professional will never change, but operating in the virtual world has accentuated the need to be human and for human connection. We realized we have to listen so we can build relationships that enable us to provide personal solutions. We believe in the value of financial advice, and for clients, the need for having an advisor became much more prevalent during 2020. Advisors help clients guide through the storm and noise around them to prevent them from making the wrong decisions based on short-term emotions. Therefore, to us, our increased footprint is the proof that our stakeholders believe in our strategy and our efforts are achieving the results we are chasing. In fact, we have had some of the best results since the business was launched. We are processing more new business cases in a shorter time, and our platform has more functionality to support advisors. We continually improve and simplify our offering to be as relevant to our clients as possible. For example, we will soon also launch the single asset class offshore Hmrc funds in South Africa. Where most competitors have downscaled and consolidated, we have expanded to grow our footprint and our expertise. Hmrc's acquisition of Liverpool-based Seneca was a case study in successfully conducting legal matters virtually, from the initial discussions to finalizing the due diligence and other negotiations. Everything happened online. Throughout the year, there was an increased appetite for offshore investments from clients and advisors alike. Clients' needs varied from wanting to protect against the currency fluctuations or looking to emigrate or merely wanting to broaden their investment horizons. Today, we live in a global village and clients are open to more opportunities than before. All the opportunities and choices do not automatically make it easy to invest globally. Not many clients are comfortable or know where to go. This is once again why advisors are so important. Guiding clients to structuring offshore investments while avoiding the pitfalls that can lead to adverse outcomes or suboptimal investments is crucial to achieve investment success. That's where Momentum Investments, as a global partner, helps to guide clients and advisors through this journey. Advisors need the expertise and partners to leverage off to fulfill the invaluable role of making clients comfortable in their investment decisions and to help them achieve their goals. Our research showed that as humans, emotions drive the decisions we make, mostly without our knowing. Here, the advisor's job is to help clients understand that doing nothing when everyone else is doing something could be the best strategy to follow. Investors don't need to pay more for making irrational decisions when fear and anxiety or greed drives everyone else to do so. Through our Noise and Investment Advice study in partnership with Oxford Risk, we aim to help guide you as advisors to manage your clients' expectations during market turmoil. To combat investment noise that affects decision making, and most importantly, to realize that although we have never experienced anything like COVID-19 before in any of our lifetimes, the market still reacted the same, and we need to avoid the thought that this time it's different. Through the Global Matters session, we want to equip you to have quality offshore discussions with your clients and avoid unnecessary noise derailing your clients' investment plans. The discussions don't stop here. Remember to keep close to our Global Matters portals for more information. For ease of reference, you will find more content on our website, regular WhatsApp updates and email communication to keep you in the know. And just a slight correction to what Ray said. I'm not actually in studio with him and Kapil in Johannesburg, but I'm joining you from Cape Town. Yes, I know, it looks as if I'm standing right there with them. I'm amazed, as I'm sure you are, that this new technology where we can create seamless interaction from across the country and the world. Thank you for joining us, and I hope you find the discussions valuable and enjoy your time with us.
Next up are three experts from the UK who will give us some insight on the market that has been in turmoil in the last year. I'd like to introduce three colleagues from Momentum Global Investment Management. Andrew Hardy and Glenn Owen, who are investment directors based in the UK, as well as Lorenzo Laposta, a senior analyst who's joining us from Italy. Morning, gentlemen, and welcome to South Africa.
Good morning, Ray.
Morning, Ray. Thank you. Good to see you.
Morning, Ray. Thanks for having us.
Andrew, let's start with you. The first question is to you. Is this year's economic recovery fully priced in already?
Thanks, Ray. There's no doubt the markets have come a long way towards discounting the global recovery ahead. However, we think there's still a lot more upside potential left for investors, particularly in those parts of markets that were hardest hit by the pandemic sell-off at the start of last year. We had higher equity exposures in portfolios a year ago than we do today, when valuations were even more compelling. But we continue to believe that equity markets will be the key driver of portfolio returns in the coming 12 to 18 months, and are positioning our portfolios accordingly. I'll talk about where we currently see the best opportunities in a minute, but first, why are we so positive? Well, we're highly confident that the world is on the cusp of an economic boom like few we've ever seen before. This is firmly underpinned by the success of the vaccination program. The benefits of that are being felt disproportionately around the world, of course, but an absolute end to the pandemic and the restrictions on activity and movement that came with it are clearly in sight. For now, among large countries, it's the likes of the US and the UK that are set to recover earliest, because their success on the vaccine rollout is increasingly enabling a loosening of restrictions. The rapid release of pent-up demand will be the key swing factor in the coming months, which markets have increasingly begun to discount since the first big vaccine news over 6 months ago. This has been no normal downturn, though. Savings don't usually grow through a recession. This time they have, though, driven by government stimulus and furlough schemes, keeping people employed in many countries. And of course, the sheer lack of opportunities to spend on holidays, business travel, leisure and entertainment, etc., as well as all the spending indirectly linked to that. It's estimated that total excess savings around the world amounts to over $5 trillion, which represents over 6% of global GDP. In the US and the UK, where furlough schemes have been more generous and lockdowns tightest, the figures represent over 10% of GDP. And that's before President Biden's first $1.9 trillion stimulus package is accounted for, which includes checks of $1,400 to most adults straight into their pockets. Which brings us to this chart and the other factors which explain why the recovery is going to be so strong, the incredible extent of stimulus that's been unleashed. Here, the fiscal and monetary response to this crisis across various countries is shown in red, measured as a percentage of national GDP in each case, and compared to other recent crises. The scale and global synchronization of this stimulus makes this response unlike anything ever seen before. Even the massive bailouts and quantitative easing following the financial crisis is nothing compared to this. However, unlike then, the fabric of economies remains very much intact, and most critically, the banking system's in rude health with very strong capital levels, meaning that key transmission mechanism can be part of the solution rather than the problem. This combination of factors is already leading to much higher consumer and business confidence, and economic activity levels are recovering rapidly. This next chart shows leading indicators of manufacturing activity across most major economies moving sharply higher in the last few months and pointing to strong growth ahead. A figure above 50 represents expansion, and the levels shown here are among the highest seen for many years, if not ever. But the big question mark for investors are around the outlook for policy from here. And again, our view is constructive. We don't see a return to fiscal austerity anytime soon, especially while sovereign borrowing rates remain so low, and with the memories of the post-global financial crisis mistakes still fresh in policymakers' minds. Taxes will rise in time, but that shouldn't be seen as today's problem, especially given it will be those most able to shoulder them that will be targeted across individuals and corporates. Instead, for now, we're likely to continue to see the opposite, more stimulus. President Biden's already working hard on his second and third massive packages, and the rest of the world is to varying extents following the same playbook. Meanwhile, liquidity is abundant and interest rates remain at or close to all-time multi-century lows. This is creating pockets of exuberance, and investors need to be wary to not get caught up in these. But the focus should be on the broad-based overall support for markets, which is unlikely to be withdrawn anytime soon. We expect rates to stay low for the foreseeable future and for liquidity to continue flowing. Indeed, financial conditions in the US are estimated to be at their most accommodative level since 2007. Quite incredible, but highlighting just how rapidly markets are normalizing. Critically, this provides huge underpinning for asset class valuations. If you believe that rates will stay low, then that crudely justifies higher valuations for all risky asset classes. Then if you also factor in that earnings will move higher at the index level, that warrants higher valuations today in anticipation of that. Now, yes, stock markets have delivered very strong returns already over the past year, but that largely represents the immediate recovery from very depressed levels. Many markets fell more than a third, so needed to rise by more than half just to get back to where they were. And the first 8 months of the recovery was driven by the pandemic winners, the stay-at-home beneficiaries like tech companies and online retail. The frequently referenced FANG index in the US, which includes the likes of Tesla, Amazon, and Netflix, outpaced the rest of the global market by 50% over that period. Although on the surface, markets have maintained a consistent trajectory for most of the last 12 months, there was actually a marked shift in early November when the first vaccine news came, and value stocks started to outperform, with an intensity that increased this year to mark the biggest outperformance we've seen for that cohort of stocks for a decade or more, as the so-called reflation trade took hold. And it's that which really underlies the question of whether markets have run too far. In the last 6 months, stocks in hitherto unloved areas like banks, mining, high street retail have surged higher and in many cases have nearly doubled. So how much more does the recovery trade have to run? The next chart, I think, is one useful way of addressing the question. It shows the cyclically adjusted valuation multiples through time for the major equity regions. This uses a longer-term measure of average earnings, which is helpful because it smooths out the huge volatility of the last year. And it shows that most markets are at or around their historical average levels. That's despite the recent recovery I've already discussed in share prices, despite much of the earnings recovery being ahead of us, not included in these numbers, and despite there being a strong case for multiples being much higher than normal today. Consensus expectations are for earnings in the US, which now represents over 60% of the global index, to increase by more than 40% this year. That'll bring these multiples down to even more reasonable levels. Now, the US is one market that stands out as being more stretched on this measure, but that's largely driven by those mega cap tech stocks in that FANG cohort, which now represent nearly a quarter of the S&P 500 index. Valuations do look excessive for many of those, and indeed for a lot of very high growth stocks. But stripping them out, multiples for thousands of other opportunities look more reasonable. But our view is that at the broad country or regional level, there are better top-down opportunities outside the US. Our home market in the UK is one that stands out for us. It's been overlooked and undervalued for years because of the Brexit overhang and the makeup of the market, which is skewed towards lower growth areas like banks, energy, and industrials. But with uncertainty over future trade relations largely behind us, and with a sharp global recovery incoming, that will favour more cyclical sectors. So I think the scene's set for the UK to begin a period of outperformance. The same could be said for several other economically sensitive countries, as well as certain sectors. Areas that have been hardest hit by the pandemic, notably listed property and infrastructure, have lagged the recovery in broader markets. For the right prime monopolistic assets, investors are being well compensated in those areas through high dividend yields to wait for the eventual recovery. And given the greater resilience to inflationary pressures and steady cash flows in normal times, we think those sort of real asset areas are likely to be re-rated before long, especially if rates stay as low for as long as is widely expected. But looking beyond these top-down opportunities, there's a lot of variation beneath the surface across all sectors and countries. Stories of disruptive growth businesses and past outperformers represent inherently more comfortable areas to invest. But it's value stocks where the best forward-looking opportunities lie now. The spread in valuations between the most expensive stocks and the cheapest is as wide as it has ever been on some measures. And there's a lot of room for value stocks to exceed what are still low expectations over a reasonable investment horizon. One of many examples I could pick is the auto manufacturers. The long-established businesses like VW and General Motors are on forward PE multiples of about 10 times versus Tesla on 150 times. Value investing doesn't have to mean buying low-quality or high-risk businesses, just swimming against the tide a little in unloved and underappreciated names. I think security selection is going to be more important from here than it has been for many years, which really speaks to the need for an active rather than passive approach. Passive strategies are, by their nature, concentrated in the past winners in terms of stocks, sectors, and countries. They don't have the level of exposure to value stocks that I think investors should be seeking at this point. So, to be clear, valuations are not obviously cheap across most asset classes, and there's relatively high valuation risk in areas such as government bonds and high growth equities. But broad equity market valuations are not particularly high versus history, especially considering the economic outlook and policy backdrop. And there are plenty of opportunities for active investors. Volatility will likely pick up throughout the rest of the year, compared to the past 12 months, which under the circumstances have been remarkably benign. But I'd encourage investors to manage those risks through diversification and maintaining a long-term investment horizon, rather than trying to time short-term moves in markets. Don't lose sight of the huge recovery ahead and the opportunity for long-term gains that it provides.
Thanks, Andrew. I wonder how much of this money from the US stimulus checks is ending up in the cryptocurrency market. In fact, Glenn, a lot of people are worried about this extra liquidity in the market. So how can one tell whether the world markets are starting to run too hot?
Well, it's extraordinary, Ray, that within 12 months of the world slumping into its steepest and deepest recession since the Second World War, we're asking the question, when's the economy going to be running too hot? Recovery is on the way, and it's going to be like no other in pace and scale. But the nature of the recession, an exogenous shock followed by swift and enormous policy action, has left the productive capacity of economies largely unscathed, while in aggregate, households and businesses have built up substantial excess savings. The shock was unusual too, in that it hit both the supply and demand sides of the economy. Demand collapsed and supply chains were dislocated. Activity levels everywhere plunged and inflation sunk into negative territory. Now, there are material implications in all of that as we enter the recovery phase. The disruption to supply chains will take time to return to normal. An increase in capacity is not an overnight task. Building a new semiconductor foundry takes up to 2 years. Developing a copper mine, clearly much longer. Additional constraints would arise if supply chains are reconfigured to prioritize security of supply over cost. As the surge of pent-up demand meets restricted supply, the result is higher prices. On top of that, the base effects of falling prices in the second quarter last year and the worst of the pandemic, they'll fall away, and inflation is going to spike for that reason alone. Little wonder then that the risk of an inflation surge, something that hasn't troubled investors in the past 20 years, has become topical. Will the coming rise in inflation be transitory, or will it be persistent and trigger a response from central banks to rein in ultra-loose policy? Now, we believe this is the key to judgment that the economy runs too hot. It's going to largely determine the durability of the recovery and the performance of financial markets. And it'll be the US where all eyes should be turned. Aside from being the largest economy with the world's reserve currency, it's at the forefront of the vaccination rollout, turbocharged by President Biden's huge fiscal packages. And with a central bank that's implementing extraordinarily loose policy and prepared to allow the economy to run hot, following its policy shift to average inflation targeting. And the impact of that change in policy late last year, incidentally, shouldn't be underestimated. What it means is that because inflation has been running below the Fed's 2% target for quite a number of years now, the Fed can run above 2% for quite an extended period before it feels the need to tighten policy. Now, those huge injections of liquidity that you referred to, Ray, earlier on, they're an underpinning to markets. Any signs of withdrawal would ring alarm bells. The Fed sees the rise in inflation as transitory, and it's intent on keeping its foot on the pedal, but markets could begin to doubt the Fed's resolve as the higher inflation numbers come through. Now, the scale of what has happened in the past 12 months is shown on this slide. It shows the size of the Fed's balance sheet, which reflects the bonds it's bought in its quantitative easing program. That's expanded by $4 trillion in the past year. And that's fed through to the money supply, up over a quarter, and at $20 trillion, not far short of 100% of GDP. That's a lot of liquidity and a lot of potential stimulus. How quickly will the surge in demand eat into spare capacity and result in shortages? Well, there's already evidence of this in key areas like semiconductors and certain materials, leading to forced production cuts while supplies rebuild. The standout feature of markets in recent weeks has been the surge in commodity prices, oil, metals, agricultural too, taking the rises over the past 12 months to 60, 70% more in some cases, as you can see from this slide here. Commentators are already talking about a new commodities super cycle. In the latest Purchasing Managers survey in the US, the prices paid component was at its highest for 13 years, with inflation of prices across most supply lines and businesses citing difficulties in attracting and retaining labor. Another key question is whether the huge liquidity provided by the Fed will ultimately feed through into inflation. This proved not to be the case after the financial crisis, despite massive liquidity injections, but circumstances are very different now. Monetary loosening in the past year and fiscal stimulus packages have been on an altogether different scale to those following the financial crisis, as Andrew showed on that slide earlier on. And this time, there's no return to fiscal austerity. Furthermore, banks were crippled by the financial crisis, and weakened balance sheets meant that lending was curtailed. Now the banks are in good shape. Balance sheets are strong, and they're willing and able to lend to support the recovery. Money supply, which reflects the amount of liquidity in the economy, is expanding in the US at its fastest rate in decades, as you can see from this slide here. And that has often been a lead indicator of inflation ahead. We see a return of inflation as the biggest risk factor in markets. If investors begin to believe that the inflation rise will be persistent, bond yields could move materially higher. The yield on US Treasuries is, in effect, the world's discount rate. A rise in that discount rate would have global ramifications, not least in emerging markets, potentially undermining all risk assets. As you can see from this next slide, which shows a range of inflation indicators in the US, inflation has picked up from last year's lows, but at this stage, it mostly reflects a return to a degree of normality. It's what comes next in the months ahead that will be more testing. We know that inflation is corrosive for savers. It erodes purchasing power, damages the real value of savings and wealth, and would have far-reaching implications for the construction of portfolios. The outcome is by no means certain. Output could rapidly respond to the surge in demand and keep prices in check. Longer-term constraints, demographics, digital disruption and competition, new technology such as AI, they could all bear down on inflation. But after years of low inflation, it would be complacent to assume that the trend will continue. Globalization, which has held down inflation over the past couple of decades or more, could well have peaked. Governments are giving greater emphasis to redistribution and regulation, and reconfiguring of supply chains could all push up costs. While core price measures are still subdued, all the forward indicators point to a significant rise in coming months. The producer price index in the US, you can see it on the slide there, is already at a decade high of over 4%, and this will feed through to consumer prices before long. A critical figure to monitor will be forward inflation expectations. These have moved up significantly from the pandemic lows, but so far only to the broad range which they've been in for most of the past decade. The Fed has the tools to deal with a persistent rise in inflation, but deploying those tools would be damaging for the economy and markets. Letting the inflation genie out of the bottle is a lot easier than putting it back in again. For the first time in many years, the risks have shifted away from disinflation and towards the upside. And these risks really should be carefully considered when building portfolios. We'll be scrutinizing developments. Headline consumer prices will be less important than core price measures, which strip out the more volatile components like energy and food. They're a better guide to underlying inflation trends. The Fed's preferred measure of inflation is core personal consumption and expenditure, which to date remains within target. Perhaps most worrying would be if price rises feed into real wage growth and into inflation expectations, as this could well signal an early end to the Fed's ultra-loose policy. Now, I'm not trying in any way to be alarmist about this, simply realistic given the extraordinary conditions triggered by the pandemic and ensuing recession. I'm not suggesting for a moment a return to 1970s style inflation, and indeed the inflation pickup ahead could well prove to be transitory. But the balance of risks has changed, and we need to recognize that in our portfolio decision taking. With the risks ahead and the uncertainty of the outcome, portfolio diversification is more important than ever. Balancing assets which offer protection against inflation, equities which benefit most from the cyclical upturn, those with pricing power, infrastructure, property, inflation-protected bonds, gold, and other real assets, with more defensive assets which would perform well in a lower inflation environment. Things like quality equities with consistent revenues, government bonds, and other income-producing assets. The key message is diversification in the months ahead is going to be more important than ever.
Thanks, Glenn. Lorenzo, the last question is for you. Investors are focusing on what they know, but what are the tail risks that aren't receiving enough attention?
Well, Ray, I think the current investors are very concerned about a few things: the length and economic of the way out of this global pandemic first. And the most common worries I can think of are about maybe speed and effectiveness of vaccine rollouts, new virus variants, countries' reopening plans, pent-up demand, economic recovery. Of course, the evolution of monetary and fiscal policies with all the consequences on inflation, on interest rates, and more generally, asset prices. And this is all very important, of course, but there are other risks out there that I think we should be worrying about too. Number one is the lack of creative destruction. Today, the correlation between economic growth and default rates is low, and it's much lower than it used to be in the past. And that's just a consequence of 20 years of intervention from authorities that, whenever needed, and especially during the most recent COVID crisis, they have been keeping more companies afloat by reducing the cost of borrowing, by offering government guarantees, by injecting capital in a few other ways. Now, this has been great for those companies. It's been great for bondholders, but not so great for economies overall, because this has allowed many unprofitable companies to stay artificially alive, mostly to avoid systemic crashes. Now, this lack of creative destruction represents a risk over the long run, because those unproductive companies that are being kept alive effectively are the same companies taking capital and labor away from more efficient businesses. And ultimately, this damages overall performance and economic profitability. To give some numbers, nowadays 1 in 4 companies in the USA is unprofitable. 1 out of 4 is currently earning less than they have to pay out as interest on their debt. In the late 90s, so a bit more than 20 years ago, it was only 1 in 20 companies in this situation. Looking forwards, for default rates to revert to historical mean, I think we'd need substantially higher real yields, but that is unlikely to come through anytime soon. The second risk that I think is underappreciated is the average person's equity positioning. According to the American Association of Individual Investors, who run a monthly survey on asset class positioning in people's portfolios, the current average allocation to equities within the US is around 70%, having risen strongly over the past 12 months. In the last 30 plus years of survey, the average equity allocation has been 61%, with the top value ever registered 77 at the height of the tech bubble in the early 2000s, and the bottom being 40% or so just after the great financial crisis. So, compared to history, we are today not far from the top. Now, people's allocation to equities is a consequence of many things, of economic outlook, perceived upside potential, but also recent past performance and opportunity set in other asset classes, like bonds, for instance. Equity allocation is not a problem by itself, but the risk behind that is that flows do have an impact on asset prices, and when investors have their pockets almost full of equities, the risk is more on the downside than it is on the upside. So a disappointment in growth, a hiccup in earnings, or simply a price correction could trigger substantial outflows. That in turn would put further pressure on stock prices. The third underappreciated risk, in my opinion, is China. 1.5 billion people, $14 trillion GDP, growing at 6% per annum. China has been for many years the engine of global growth, and more recently, their tech giants, names such as Tencent, Alibaba, Meituan, or Pinduoduo, to just mention a few, they've grown massively and they have provided global investors with spectacular returns along the way. And like most new disruptive business models, those companies have operated largely unchecked so far. But in the back end of last year, the Chinese government stepped up and trying to rein them in whilst protecting consumer rights on areas such as personal data, privacy, and anti-competitive behaviors, etc. The government is now issuing antitrust rules, it's fighting monopolies, and it's regulating the use of personal data within those platforms. For instance, last year, the government stopped Ant Group's IPO. They investigated and fined Alibaba. They fought group buying platforms. And these are only the first elements of what can only be the end of the wild and free era for those tech platforms. And this is not only a risk for those names, but is also a risk to the growth engine that's been driving capital to China in recent years, and it's a risk to the wider economy too. The last risk I can think of is the democratization of finance. Over the past few years, technology has made financial services available to virtually everyone. Now, financial markets and investment options that once were a VIP area reserved to professionals only, now they're available through a click of a button on your phone. It's all very easy. There's plenty of platforms where retail clients can buy stocks, bonds, currencies, and even options at very low cost with just a few clicks. And that's pretty great. But this is not without its share of risks. One risk is obviously to the users themselves, who might be simply buying highly leveraged instruments like futures or CFDs without maybe fully understanding the risks behind them and the potential for losses they come with it. Also, fintechs have almost made a game out of trading with their simple interfaces and flashy colors. Millions of people around the world, they gather on social networks, they share views on stocks and spend actual money based on what they read on a forum or what Elon Musk tweeted about an hour ago. Think about what happened with GameStop earlier this year. I heard of people gathered on a forum called Reddit. They managed to push GameStop's price up by 1,000%, that is tenfold, and then back down to almost where it started from, all of that just in a matter of days, without any fundamental reason behind. They simply did it because they could, because it was fun, it was a social activity almost. And some of them made big money, others had big losses. And similar things could be happening right now with cryptocurrencies. It's really hard to forecast sometimes. Which brings us to the second risk. And this time it's not for people, but it's to financial markets themselves. And it's your usual battle between investment and speculation. If one believes that the primary objective of financial markets is that of efficiently directing capital from people who want to grow their capital to businesses who need capital to grow, then these wild mass behaviors are certainly a risk to markets' integrity. So in conclusion, I think the pandemic reminded us how risks can emerge out of just nowhere. Who would have thought 18 months ago that a virus would just come out, spread around the world, and shut the whole economy down for many months to come? Today, as my colleagues mentioned, we have a constructive view on equity markets. We believe the opportunity set for investors is quite good, but risks abound as always, and diversification remains paramount.
Now we're going to take a commercial break and watch a short video. You would have heard Jeanette speak about MGIM's acquisition of Seneca. This video explains how this exciting development will help deliver appropriate outcomes for your clients. After that, Kapil will be in studio with his guests.
It's a Beatles and Stones collaboration now in full effect. North meets South, Liverpool and London, joining forces in a combination of asset management talent. Momentum Global Investment Management, or MGIM, acquired Seneca Investment Managers at the end of 2020, and the combined business has assets under management of over £4.5 billion and offers a comprehensive suite of strategies for financial advisors. With over 40 years of combined heritage in multi-asset investing, we've come together to deliver a wide range of outcome-based multi-asset investment solutions. Our outcome-based investing philosophy is a proven approach with a focus on optimization to increase the probability of delivering the chosen outcome for clients, smoothing the investment journey along the way, keeping the client invested through all market environments. We have a culture of building partnerships with financial advisors, discretionary fund managers, and wealth managers, which bodes well for the growth of the combined business. We believe that financial advisors should be able to access our dedicated outcome-based investment process regardless of whether they use a unitized solution or model portfolios for their clients. We therefore deliver a range of risk-profiled portfolios for both, ultimately built on the same outcome-based investing philosophy. With a risk-rated multi-asset range of 5 fund solutions, including a distributing high-income solution, we believe we can blend well within clients' existing portfolios to both enhance diversification and the delivery of investment returns. For those advice firms who require a core approach to their client investments, we offer a range of 6 model portfolios and an income portfolio, again encompassing our outcome-based philosophy and accessible through 10 platforms. Our range of solutions is completed by the Momentum Multi-Asset Value Trust, a risk-profiled investment trust leveraging the team's best ideas and an ideal consideration for discretionary and wealth advisors as part of their private client portfolios. If you have clients for whom the delivery of their chosen outcome is important, then consider multi-asset investing with Momentum Global Investment Management. Visit momentum.co.uk and we'd be delighted to engage further on your requirements. Because with us, it's personal.
I'm joined in studio by Hmrc Landman, who is the head of Momentum Wealth and Wealth International at Momentum Investments in South Africa, and Jeffrey Wiseman, the Chief Executive Officer at Momentum Trust Limited. Joining virtually from Guernsey is Jeff Gavey, the Managing Director at F&B International Trustees Limited. Jeff, let's start with you. Can investments get stuck in the Suez Canal?
Well, thank you, Kapil, and good morning, everybody. I think that's exactly the question that should be asked, and I think the answer is yes. So I'm going to talk to you today about the issues of offshore probate, or executorship as you would call it, and what you do when your clients unfortunately pass away and you need to try and help the family to obtain ownership of the assets. So as Kapil mentioned, I represent F&B International Trustees here in Guernsey, where we've been for over 40 years. We're the only offshore fiduciary services provider of the first rank group, so many of you will obviously have heard of us, and we cover pretty much the same function offshore as your fiduciary services companies would in South Africa. So the one I'm going to cover today is, as I said, the issue of offshore probate. So as Kapil said, it's a little bit like getting stuck in the Suez Canal. So I'd like to sort of, use my little slide, which I dredged up from the internet, just to add a little bit of levity into what is a fairly dry and boring topic. Let's assume your client has passed away and you need to help your family or the family to obtain title ownership of the assets. So the first thing you might try doing is sending them the South African letters of executorship and saying, here we go, can you pass the assets over to us, please? What you're going to find, though, is when you go to Guernsey, Jersey, the Isle of Man, UK, or pretty much every other jurisdiction in the world, the institution, bank, finance house is going to say, no, I'm afraid not. That holds no legal validity here in Guernsey or Jersey or wherever at all. So what we're going to do is we're going to have a look at all the roadblocks on the way and what exactly you need to do to bypass them and get your ship down the Suez Canal and back to Johannesburg. So the first thing to understand is the offshore probate or estate administration process is not entirely dissimilar to what you would find in South Africa. But our experience is that advisors will often understand that process, but they will then vary in anything from, well informed to completely in the dark. So my purpose is to take you through the sort of the high level processes that you can expect to find, and exactly how you can go about doing it, and how institutions like ourselves can help you. So by the end of the short presentation, I hope you'll have a better understanding of what's involved, the costs, the timescales, the documentation, and exactly how you go about helping your clients. So the first thing is, don't get worried about notes. There will be handouts, information sheets, fact sheets available in the pack at the end of the meeting. So as I said, the offshore estate administration process is not entirely dissimilar to South Africa. You have a master's court. We have in Guernsey, which I'll use as my first example, an ecclesiastical court, which is the last probably the last church court, I think, pretty much anywhere in the world. There you go. Lovely old sort of Victorian Georgian building in the heart of St. Peter Port. And there is where the local executorship process takes place. So as I said before, the South African letters of executorship has absolutely no legal status in the offshore world. So what you need to do is you need to understand firstly where all your assets are. Okay, so once you understand where they are, let's say in this case, you have a momentum wrapper in Guernsey. So the first thing you need to do is you need to have details of all the assets, and then you need to basically approach somebody called an attorney, someone like FNB International Trustees, in the place where you have the asset to act on your behalf. Then that attorney will ask you for a long list of documentation. Okay, so what you really need to know is you'll probably need to have a court-sealed and certified copy of the letters of executorship with the will annexed, a court-sealed and certified copy of the death certificate, the last residential address of the deceased, the maiden name, if applicable, and the value of the assets at the date of death. So you'll need to provide the attorney with copy statements of all of those assets, where they are, and then even more annoyingly, if the will is in Afrikaans, you will need to get a translation into English from a translator approved by the Master's Court in South Africa. Okay, so I think you can see that, it's not necessarily that difficult, but there is a fair package of documentation which will take you a little bit of time to get together. So once you've got all that together, you submit it to the attorney in Guernsey, and then what they will do is they will then issue a power of attorney for the executor to complete in favour of FNB, and then we submit all that to the local ecclesiastical court. Okay. If the ecclesiastical court is happy, someone from FNB, I've done it many, many times, goes to the ecclesiastical court on a Friday morning, puts their hand on the Bible and swears an oath in front of the Dean of Guernsey to faithfully administer the estate. As I said, all very, very quaint. So once that's happened, it takes about a week in Guernsey, and you will then receive what is called the Guernsey Grant of Probate. Okay, so spoken out like that, it sounds pretty straightforward, but I think what you need to understand is that from the time that you first approach an attorney, putting together the documentation, submitting it, getting the power of attorney sworn in front of a commissioner of oaths or a notary public, probably takes about 10 to 12 weeks, possibly even 3 or 4 weeks longer. Okay, so I think from start to finish, you're talking 4 months if everything goes well. So that talks to the timelines. I think the other thing there are court fees in all of the jurisdictions. So in Guernsey, for say an £80,000 sterling estate, you'll pay about £150. In Jersey, about 600. Isle of Man, about 700. And in the UK, about 100. On top of this, of course, you can add the normal executors' fees, which, not dissimilar to South Africa, are around 3%. So as I say, there will be fact sheets giving all of these details, but I think the key thing to understand is that the process is not entirely dissimilar to South Africa. It can take 3 to 4 months and perhaps even 4 to 5 in the Isle of Man and the UK. And there are costs involved, and there are charges, and there's really nothing you can do to avoid it. So I think the summary that you can take away is find somebody who can assist you, such as a firm like ours. We can deal with the Guernsey, Jersey, UK, the Isle of Man, and start the process of the offshore assets as soon as you're able to obtain the South African letters of executorship. And I think at that stage, I'll hand back to Kapil.
Thank you, Jeff. That very much doesn't sound like the Suez Canal in terms of how to approach grant of probate. Thank you for doing that. Is the deceased estate reportable to Hmrc if there are UK assets?
I think that's something that advisors and clients often miss, which is that if you hold assets in the UK, you have to go through the UK probate or executorship process. And the Hmrc, the equivalent of your SARS, will want to satisfy themselves that you are not UK domiciled. In other words, you're not liable to estate duty or inheritance tax, as we call it, on those assets. And of course, even if those assets are over £325,000 sterling, even if you've never ever been to the UK, they're called situs assets, and they would be subject to inheritance tax at 40, which is 40%.
Let's keep with the rapid fire. Who decides if probate is required?
Okay, the institution. So let's say you have assets with momentum in Guernsey. They would decide whether probate is required, and I believe from memory they set the level at £10,000 sterling.
Okay, who decides or sets the probate process?
Each individual probate court in each jurisdiction. So obviously in the UK, the various regional probate courts, Guernsey and Jersey and the Isle of Man from the respective probate courts, or as you heard in Guernsey, from the ecclesiastical court.
It all sounds very admin intensive. How long will the process take?
As I said before, from the time that you obtain the documentation and it's in the hands of the attorney, so don't forget it might have taken you 2, 3, 4 weeks, to get all the various documents certified and prepared. It can vary from between 3 months in, say, Guernsey and Jersey to sort of 4 to 5 months in the Isle of Man in the UK.
Do you need to employ the services or any agents or associates in the UK, Isle of Man or Jersey to assist you if you are based in Guernsey?
No, in Guernsey we're able to, and we frequently deal with estates in Guernsey, Jersey, the Isle of Man and the UK without any use of attorneys.
Thank you, Jeff. That was an incredibly insightful session. Jeffrey, in South Africa, you are up next. Are you playing hopscotch in a global minefield? When should a financial planner consider roping in a specialist on global matters?
Thank you, Kapil. One of the many challenges financial advisors face is determining their own boundaries and when to obtain specialist advice. There is no doubt that increasing globalization has introduced a level of complexity to estate planning, whether it be in relation to tax, succession, or the implementation of estate planning structures. While it is difficult to set absolute rules that must be followed, in the following session we identify a few principles that may be of assistance and also identify some of the complexities associated with certain issues and how they may be approached in practice.
How should financial advisors approach setting boundaries regarding the advice that they provide?
As financial advisors, there are certain things that fall squarely within our domain, such as developing financial plans for clients and advising on the implementation of products. Where it does become murky is that advice on certain products involves explaining their tax consequences, whether it be an explanation of five-fund tax and its effect on endowment policies, the tax deductibility of contributions to retirement annuities, or the estate duty consequences of certain death benefits. Why should this then be any different from advising clients on how they should fund their offshore trust? For me, the answer lies in the level of subjectivity that needs to be applied to a client's specific circumstances and the likelihood that someone may be required to defend the advice on behalf of the client with the authorities. The higher the level of subjectivity and the more likely the need to defend the advice, the greater the likelihood that a specialist should be roped in. Advice is often contrasted with guidance, and this may be a useful starting point in understanding our boundaries. In the United Kingdom, the Financial Conduct Authority describes guidance as an impartial service that helps clients to identify their options and narrow down their choices. It does not tell the client what to do, that decision remains with the client. A person providing guidance has a responsibility to ensure that the information that they provide is accurate, but the risks associated with providing guidance are less than those associated with providing advice. Guidance is generally offered for free. Advice, on the other hand, involves the recommendation of a specific solution or course of action and will be aligned to a client's specific set of circumstances. The liability associated with providing advice is much greater than providing guidance, and a person receiving advice has a legal recourse against the provider of the advice if that advice proves to be incorrect. It is usual for recipients of advice to pay for that advice. In many countries across the world, financial advice has also become increasingly regulated in recent years. We have also seen a tightening up of the provision of tax advice in South Africa, with the requirement now that, subject to certain exceptions, persons advising clients regarding the application of a tax act must register as a tax practitioner. It seems clear, therefore, that the authorities wish to regulate tax advice separately. When setting boundaries, financial advisors should first establish whether the advice required falls within their own regulated activities. If it does, then there's a good chance that they will be able to handle the situation on their own. Where it falls outside of these circumstances, then, such as how to fund and structure an offshore trust, then it makes sense to call in an expert.
Speaking of offshore trusts, the recent relaxation of exchange controls has meant that offshore company trusts may become viable options as estate planning tools for more South African investors. How does one navigate between guidance and advice in establishing these structures, and what expertise do we need?
The two main changes to exchange control regulations over the years have included increasing the amounts that individuals are permitted to take offshore, and most recently the lifting of the prohibition on loop structures. In broad terms, a loop structure is one where a South African exchange control resident takes money offshore to invest back in South Africa. Individuals establishing these structures need to identify and rope in their offshore service provider as soon as possible. And the client will probably also be required to obtain South African tax advice regarding the local tax implications of the proposed structure. When it comes to establishing offshore structures, it is becoming increasingly common for offshore trustees to require prospective clients to obtain formal tax advice in the jurisdiction where the client is resident before implementing the structure. While this may appear tedious and expensive, obtaining this advice provides protection to the trustee and also ensures that there won't be any nasty surprises once the structure is implemented. If the structure itself then wishes to invest in another jurisdiction which may result in tax consequences, then tax advice should be sought in that jurisdiction as well. For example, if the offshore trust wishes to invest in fixed property in the UK tax advice will be required, as this is a complex and tricky field.
Many South African families have family members scattered all over the world. How should we approach such situations, and what is the role of the financial advisor there?
A fairly common scenario for many South African estate planners is that they have family members scattered all over the world. I once came across a scenario where the estate planner is a South African resident. He has one child living in Australia, another in Israel, and yet another in the United States. While the tax and other implications of the local structure may be familiar to the South African resident, often the consequences of the various jurisdictions where family members are resident may not be familiar. Each of these jurisdictions potentially applies different tax consequences to the trustees and beneficiaries of trusts, and it's unlikely that you will find a single expert to comment authoritatively on the tax consequences of all of the jurisdictions. Certain jurisdictions don't even recognize trusts at all, and alternatives therefore need to be considered. Another similar scenario exists where individuals have links to more than one jurisdiction. For example, you may have a client who spends part of the year in Europe and part of the year in South Africa. If he wants to then create an offshore structure, he would need tax advice in the European jurisdiction and in South Africa to understand the full implications of what he's planning to do. Clients may be overwhelmed by the complexity of all the different pieces of advice that are required, and accordingly, real value can be added by assisting clients to identify suitable practitioners in those jurisdictions to provide relevant advice, and also for somebody to coordinate the various pieces of advice that are provided.
We are actually often asked about whether clients should have separate wills dealing with their assets situated abroad. Are there any specific considerations when it comes to having separate wills, and if so, what are these?
Well, the answer to this is that it depends. Where we are familiar with the laws of succession in a particular country and they're not dissimilar to South Africa, then a single worldwide will may be suitable. But where there's an element of unfamiliarity, then the advice of a specialist in that other jurisdiction should be sought. The law of succession is potentially complex, and it is not uncommon for us to assume that all countries apply a system similar to our own. In South Africa, we apply principles of freedom of testation, which means that a person may, by way of a will, bequeath their estate to whomever they want, which is why wills are so important in our society. There are some limitations to the freedom of testation, which typically include maintenance and accrual claims, and also bequests that may be regarded as unconstitutional. Freedom of testation doesn't apply in all jurisdictions, however. For example, much of continental Europe applies principles of forced heirship, whereby the law determines who is to benefit from a person's estate. This may be complicated even further if the person is domiciled in a country other than the one where the property is situated. In these cases, the law of the domicile of the person will apply to movable property, and the law of the place where the property is situated will apply to immovable property. When dealing with assets situated in Europe, one must also take cognizance of the EU regulation known as Brussels IV. This regulation deals with jurisdiction, the validity and admissibility of wills and succession agreements, and also the European Certificate of Succession. It all becomes very complicated, and it is therefore important to make sure that proper advice is obtained up front. It is always better to plan around the regulations while the client is still alive than to try and fix the situation once the person has passed away. By then, it may be too late.
In conclusion, what criteria do you suggest could be used when deciding whether to rope in a specialist or not, and what are the benefits to the financial advisor and client in doing so?
I would suggest that the starting point must always be whether the advice required falls within the scope of the financial advice that the advisor is providing to the client or not. If there are any doubts or concerns about the tax consequences of implementing a particular solution, then the client should obtain formal tax advice. In line with the definition above, formal tax advice should be given by someone who would be willing to argue the view on behalf of the client should the opinion be challenged at any stage. In other words, the person providing the advice must take full accountability for the advice, and it is therefore likely that he or she would want to charge a fee for providing the advice. The main advantage to the client of obtaining the support of specialists is that they are able to plan with a measure of certainty regarding the consequences of implementing the particular solution. For the financial advisor, it is the comfort of knowing that reasonable steps have been taken to ensure that the client is properly informed regarding what is proposed.
Thank you, Jeffrey. Let's turn our attention on Hmrc. Hmrc, should clients buy more life cover if they don't use an offshore wrapper?
Morning, Kapil. Let me start by saying that from a new business inflow perspective, the discretionary offshore risk products have always been popular in our industry. However, current trends have shown strong support for offshore life wrappers because of its potential tax, succession, and estate planning benefits to its investors. So let's unpack this using an example where we compare the international list product, which we of course call the international investment option, to the international endowment option. So let's consider a family of 4 where the parents and their 2 children invest in an international discretionary investment product and select to have joint ownership. So this results in an equal ownership of 25% between the family members or contract owners. When the father passes away, his portion will automatically accrue to the 3 remaining contract owners. There is a CGT rollover relief, but the Section 4Q deduction applies only to the portion which he leaves to his wife. When she passes away, her portion will accrue to their children. CGT and estate duty will apply on the mother's portion of this investment. Now, for example, endowments work differently. Guernsey law allows for joint and survivorship provision between the spouses. So for the international endowment, let's say that the parents have selected the joint ownership and appointed their children as additional insured lives and successor contract owners. In this example, the parents own the contract, and whilst the children as insured persons and nominated successors have no rights over the investment while their parents are alive. So then, when the father passes away, his portion will accrue to his wife, and due to the joint and survivorship provision, CGT will not apply, and the Section 4Q deduction now applies on the full amount. The mother is then the sole owner of this investment. When she then passes away, the contract continues because they are remaining insured persons, the children. The contract will accrue to the children in their capacity as successor contract owners, and there will be no CGT. Estate duty will apply within the mother's estate as a deemed asset, of course. In each of these two above examples, neither probate nor executive fees, which we have now discussed at length, will apply because there is no need to consult a will, due to the way in which these investments were structured.
Hmrc, so if I can summarize, although both products allow for joint ownership of the investment, only the endowment allows for joint and survivorship provision between the spouses.
Yes, Kapil, that is absolutely correct. However, we also need to discuss the two variations of the endowment wrapper, the life insurance bond and then of course the capital redemption bond. The life insurance bond allows for an unlimited number of contract owners. The contract owners can, in addition to themselves, also appoint an unlimited number of lives insured. This solution also allows spouses the option to select the joint and survivorship provision, which we of course discussed earlier, and the investment structure and its appointed role players determine the outcome in the event of the death of one of the contract owners. Both successor contract owner and beneficiary for proceeds nomination can be used for effective estate planning, allowing for the unique needs of each of the investors. Then secondly, Kapil, the capital redemption bond, which is of course a sinking fund structure. It allows for unlimited contract owners, but it does not have lives insured. This structure allows for both joint and survivorship provision between spouses, as well as for contract owners to nominate successor contract owners, which will ensure continuation of the investment when the original contract owners pass away. This product is often used by entities to allow for the longevity of the investment. So in summary, the Momentum Wealth International product offering, if applied and structured correctly for a client, offers all the benefits required to ensure that investors will not need additional life cover. It of course always depends on the amount invested and whether sufficient provision for estate duty has been created in the estate.
So Hmrc, is a trip to Lesotho international travel? Can a local LISP cater for all of your clients' offshore needs?
Interesting question, Kapil. Aren't we also ready to pack our bags? But back to your question, although a client's needs could be met by both local and international platforms, there are a few key considerations when selecting the most suitable solution for a client. For example, the difference in the fund range available to meet the investment needs, the impact of VAT on service and administration fees, contract structuring options available for succession planning, and of course the tax implication on the investment return. But I think let's go through some of these in a little bit more detail. True internationally domiciled platforms generally offer a wider range of foreign currency denominated investment components to choose from compared to your typical local platform. You also, of course, have access to components such as international share portfolios, exchange-traded funds, and of course international model portfolios. Given the wide range of components available, it is more likely that a client's investment and portfolio construction needs would be fully met by the choice of a truly international platform. Then, in terms of estate planning, international platforms generally offer many more options to natural person investors because of different legislation. For instance, local list product can easily allow for single contract ownership, but our international platform allows for single or joint ownership of contracts, and as I mentioned earlier, the option to have joint and survivorship provision between spouses. This allows, of course, then for continuity on death of a contract owner and saving the executive fees that Jeff in Guernsey was talking about earlier. VAT is applicable on local platform fees for certain products. So Kapil, the client could be in Lesotho, yet still pay South African VAT on its administration fees. That does not apply to the admin fees of a truly internationally domiciled platform, and this may be of importance to a client wishing to immigrate to another country but does not want to use an endowment wrapper. Being then domiciled in another country using an international platform and possibly an international list product that now attracts South African VAT on its admin fees would be a cost consideration and possibly a deciding factor to an advisor.
Himna, other than VAT, what would you say are the other tax considerations before packing your bags for Lesotho?
Kapil, of course, clients in higher tax brackets of more than 30% could be paying higher tax in their own hands if they stick to local or international list type products as their offshore investment vehicle of choice. So our international endowments are taxed using the 5-fund tax approach that Jeff also referred to earlier, which means that a client in, say, the 41% or 45% tax bracket will be taxed at a rate of 30% instead. If they only use products outside the endowment structure, they could find themselves paying more income tax and as a result also higher CGT in their own hands. Then lastly, so by using products with fewer succession planning options, the client would not only be exposed to paying executive fees and estate duty, but could also be exposed to paying CGT in their last income tax return. So although South African legislation does allow for spousal inheritance that reduces the tax liability, the solutions offered by our Momentum Wealth International platform, being a truly offshore domiciled platform, simplify the tax planning and structuring, both for the advisor and his clients. Therefore, Kapil, although a trip to Lesotho could feel like you have left the borders of South Africa and you are destined for a truly overseas trip, it cannot be compared to a trip to Guernsey or the United States of America.
Thank you so much, Himna. Before we take a comfort break, please watch a very short video about our exciting WhatsApp community for financial advisors. With the Global What Matters WhatsApp community, we want to empower you to have in-depth offshore investment conversations with your clients by providing you with convenient access to regular offshore investing content, such as articles, videos, and fact sheets. It's easy to access the WhatsApp community, and you can opt out at any stage. We'll send you all an SMS with the link to the bot after the event.
Momentum Investments has an exciting new WhatsApp community for financial advisors, an industry first. The Global Matters WhatsApp community aims to empower financial advisors to have in-depth offshore investment conversations with their clients by providing them with easy and convenient access to regular and exciting offshore investing content, such as articles, videos, and other insights. To access the WhatsApp community, financial advisors will receive an invitation on WhatsApp with a link. Clicking on this link will send the user directly to the Start Now option. Clicking on Start Now will take the user to the Global Matters WhatsApp community, where the user can send the message which will already be typed. For more information on Global Matters, click Send. The user will receive a welcome message and the option to opt in. Financial advisors can also opt out at any stage by replying with 8. The Global Matters WhatsApp community will have 7 menu options, and a user can access this menu at any time. For an advisor to see the latest updated global content, they reply with the corresponding number of the menu item. Replying with 0 takes the user back to the main menu. We'll be sending a reminder 4 times a week to remind advisors of the updated information. It is important for us not to spam or overload financial advisors with information. Therefore, advisors will be able to choose when and which content they access after they have opted in to be a part of the WhatsApp community. We will never send more than 5 update reminders a week. With us, it's personal.
Welcome back. Next, I would like to introduce Richard Stuckey and Robert White, a portfolio manager and senior analyst at Hmrc in the UK, as well as Natalie Harrison, who is the global fund specialist at Momentum Investments based in South Africa. Richard, With an estimated 630,000 publicly traded companies globally and more than 40,000 funds, what role does investment research play?
Well, good morning, Kapil, and good morning to everyone listening. As you say, does investment research have a critical role to play? Well, just listen to the numbers you quoted. Over 600,000 publicly traded companies for investors to choose from. More than 40,000 professionally managed funds. Some sources put that figure closer to 100,000, in fact. So I would question, how does one go about selecting a sensible subset of investments from that enormous opportunity set without investment research? Now, at the same time, obsessively trying to research everything is a key mistake that some investors make. You simply can't do it. The problem is too large. And instead, what you end up doing is just wasting time. What we at MGIM endeavor to do instead is to spend our time wisely, condensing what is a huge problem, i.e. all of those different things you could buy, into something more manageable. Okay, here are those numbers again, plus a couple of others. So starting in the top left-hand corner at MGIM, we look at opportunities across 15 liquid asset classes, from equities through to commodities. Moving clockwise then on the slide, the next item shows that we look across 195 different countries. Now, clearly, investment opportunities are not evenly distributed across them, but nonetheless, there's a lot to look at. Next, as we've already heard, there are 630,000 listed companies we could either lend money to or else buy participatory interests in, i.e. shares. And finally, there are at least 40,000 professionally managed funds, as shown bottom left. So then, faced with all of this choice, what are you going to pick for your portfolio? Well, the first question I think you should logically ask is, does it matter what you choose? Could you not simply select investments at random for your portfolio? Well, history shows that not all investments are created equally, unfortunately, as this chart tries to illustrate. If you had chosen to invest in commodities over the past 3 years to the end of March, you would have lost over 15% of your initial investment. If, on the other hand, you had allocated to developed market equities, shown at the top, well, you would have gained close to 50%. So therein is a nigh on 65% spread. There are, therefore, a wide range of possible outcomes, and not all investments are destined to appreciate in value, I'm sorry to say. Even an investment that is ultimately destined to go up over time will not necessarily do so in a straight line. This chart, looking at the performance of global equities, shows that at times investors will be sat on very meaningful short-term losses. Therefore, not only do you have to pick a sensible portfolio of investments, you also need to have the conviction to stick with it during the inevitable bouts of volatility. Finally then, on this slide, having firstly acknowledged that the opportunity set is wide, and secondly that the range of potential outcomes is wide, there is also a wide range of questions that you need to consider. Starting in the top right-hand corner on this slide and working our way around clockwise, if you choose to invest in professionally managed funds, first think about what type of structure you want, be it an ETF, which provides intraday liquidity, or a more traditional mutual fund. Make sure you understand the costs and benefits of both, and in particular, under what circumstances an ETF can start to trade at a meaningful discount to its net asset value. Next, pay very close, I would say nigh on obsessive attention to liquidity. That's the next item on our list as we move clockwise. The wrong liquidity profile can lead to the permanent impairment of your capital if you are forced to sell your investment at the wrong time. It is possible to hold less liquid investments in a portfolio, but sizing is a key consideration in order to avoid becoming a forced seller. Next, how do I judge whether a professional fund manager is skillful or just plain lucky? Well, at MGIM, we evaluate managers across 45 different criteria, and we evaluate their historic performance and also liquidity across no less than a further 40 criteria. Critically, I would say make sure you understand your manager's structural biases. It may be that they never invest in the energy sector, in which case we should neither credit them nor penalise them for any performance that arises related to not owning energy. Next, is there a role in your portfolio for systematic strategies which seek to deliver outperformance through predictable rules-based portfolio construction? We think there is, and so our equity and fixed income solutions both feature some systematic managers. The list goes on. Next, pay close attention to fees clearly, but also consider net of fees returns. Cheap is not the same as value for money, and sometimes it is worth paying up for better prospective performance. The debate over active versus passive management goes on. We caution against being wed to either. In certain asset classes, a passive approach makes sense, and in others, there are very good opportunities for active managers. And finally, how should one go about incorporating environmental, social, and governance factors into one's investment analysis, bearing in mind that environmental objectives are at times not aligned with short-term social needs? The answer is it takes a huge amount of ongoing research and also engagement with companies. A lot of questions then, and thank you for bearing with me, but clearly these are just a very small sample of the questions that we all as investors need to take account of. Addressing a wide opportunity set, number one, a wide range of possible outcomes, number two, and finally, that wide and constantly evolving set of questions needs a dedicated research resource, I would suggest. Along with Robert and Natalie, who is shown on this slide and who you will hear from momentarily, I am primarily responsible for the global investment solutions we manage on behalf of South African investors. That said, we three are just a very small part of Momentum's dedicated global investment resource, as this slide shows. You don't need hundreds of people doing investment research. Indeed, I'd suggest that you don't want hundreds of people. The more people you have, the more time is spent on managing them, and the less time invariably that is spent on managing client capital. You do, however, need a decent headcount. In conclusion then, and thank you for listening, investment research has a critical role to play in helping investors grow their savings, and we think we have the right scale for the task. Thank you very much, as I say, for listening.
Robert, now that we know we should rely on a credible research partner, tell us how you select or identify the best in-class specialists from around the world.
Okay, thank you, Kapil. So there are a couple of problems you need to solve for when searching for a credible research partner. So firstly, as already has been touched upon, the available universe is huge, so you have to true it down. Secondly, the average manager underperforms the benchmark, and so you're fighting an uphill battle from the start. So let's start with the second problem, as it's the throughout our entire business, we currently only allocate to around 130 active managers. And so we can afford to be highly selective in who we choose. For us, the average is nowhere near good enough. We're looking for something truly exceptional when we allocate to third-party specialists. So we have a detailed set of criteria by which to judge managers, and we apply the same framework to all potential new investments. This results in a scoring system, and here we can objectively compare and contrast managers with one another and rank them based on a number of criteria. So the key high-level factors we look for when selecting specialists are the firm, the team, the strategy, risk flags, and performance. And I can touch upon each of these briefly now. So with regards to the firm, we only want to be invested in healthy businesses that are well run and provide a supportive environment for the investment staff. So this comes through particularly in the remuneration structure, where we look for the key personnel to have appropriate alignment with us as investors. So our favourite businesses tend to be manager-owned private boutiques, and these are run by investment people with a long-term horizon in mind. So typically the portfolio managers, they want to run money for their entire careers, and that sort of longevity matches nicely with the typical investment horizon of many underlying investors who will be saving for long-term events like retirement, for example. And when we assess the strength of an investment team, we obviously make sure that they are well-resourced and have the appropriate experience and track record to run that particular mandate. Just as important, however, is to understand the culture of the team, how decisions are made and to what extent there is any key man risk. Ideally, we look for teams with broad experience, so if the lead PM gets hit by a bus, the team can continue to run things well. But another really underappreciated attribute is the focus of the investment. So in large businesses, sometimes some managers and analysts can have their attention split between a number of competing requirements and different strategies. Our favourite setup really is to back a team that can spend the majority of their time running one core strategy or slight derivatives thereof. And that's really so they're not dividing their attention across multiple different projects and can really focus on what we're paying them to do. So the team and the firm are obviously important, but when we do our scoring system, we put most emphasis on the strategy, and that encompasses the entire investment process, the philosophy, and that includes portfolio construction, risk management, and ESG considerations. Consistency is the key thing here, as having a repeatable, robust process really helps the very best managers to add value throughout the ever-changing economic landscape. We look for managers that have spent some time fine-tuning their approach and who have shown that they can withstand the most challenging conditions. And we've certainly seen that they can occur really from left field in recent years. And this really ensures they have the courage and conviction to stick with their process when times get tough. The best way for us to find these managers is through frequent manager meetings. So our well-resourced team spends a good portion of their time meeting with potential new managers, and where we can quiz the PMs on particular stocks and see if their explanation is consistent with what they say about their philosophy. This is a crucial issue at the moment, particularly with regards to value managers, as many of them have shifted to become more growth-like in recent years. And this is really because the last decade or so has been particularly difficult for value as a style. So that sort of style drift is important to identify when you build style-balanced portfolios, as we do. So our highest conviction value managers have been following the style for their entire careers. We have built confidence in their adherence to that philosophy by monitoring them either at their current firms or at previous firms, for well over a decade in some cases. That sort of closeness to managers really kind of helps you build confidence in this consistency, and it's a real vital part of what we do. So I think here I'll briefly mention some of the quantitative tools we've developed, and that helps us with this analysis. One of these is customized style analytics reports. So we use these to quantitatively define what it means to be a growth, value, or a quality manager. And we run historic Z-scores, which show how managers rate on those metrics. That's based on their historic holdings. We also run trading reports, which show at which points managers buy and sell important stocks, as well as customized attributions, which show how they have generated performance. All of this information is compared with our qualitative assessment of the fund and helps to inform our questioning when we meet with managers. The key thing we're looking for here is, are managers doing what they say? Another aspect we look at is performance. And generally, we think investors tend to put too much emphasis on past performance, and it's actually a comparatively small part of our overall assessment relative to the other factors that I've mentioned. But nonetheless, it does reveal some interesting information. We weigh up relative performance against the appropriate style benchmarks, and we read as much into risk data, such as drawdowns and tracking error, as we do to return data. So many of our peers have some arbitrary time requirement for track records. Typically, this is about 3 years, and that's before they even look at a manager. We think this is a mistake, as investing earlier often leads to additional benefits, such as capturing excess returns, before a fund has grown too large, which happens, relatively often, and also accessing any reduced fee share classes that may be available. When we have conviction in a manager and they've shown they can run a comparable fund well, we're happy to invest in an early stage. So the last really factor to mention here, but by no means least, is the importance of risk flags. So we have a number of risk flags here which would preclude investment in any manager, no matter how high our conviction was in any of the other areas. So the most important risk flag to mention here is liquidity, which Richard briefly touched upon. So we run liquidity analysis on the portfolios that our managers run. And this gives us an idea of how quickly they could move everything to cash in the most distressed market environments. If there are sufficient risks that managers won't be able to meet their obligations due to liquidity mismatches, these are complete red flags for us. And where we do want to access inherently illiquid asset classes, typically as property or private debt, for example, we do so through closed-ended investment trust structures, which are much better vehicles for accessing these areas compared to daily dealing open-ended vehicles. So sustainability is also a crucial component, that runs through all of our analysis, both at the firm and the fund level. This isn't something that we just bracket out into a separate score. It's really integral through every stage of our scorecard and our whole analysis. So any firm that we partner with is assessed based on its environmental, social, and governance credentials. We consider things such as the composition of the board, the treatment of various stakeholders, and environmental credentials, and so forth. And we complement this external data from Sustainalytics to ensure that portfolios are run in a sustainable manner. So going right back to the start of my answer, I faced two problems. The other problem was, how do we narrow down this universe of 40,000 odd funds? So we take a few different approaches. So firstly, simple screening definitely has its place. So we have access to all the usual databases like Morningstar and Bloomberg, and we look at overall performance as well as through specific time periods. The specific filtering criteria we use will depend on what we're looking for. A quality manager, for example, will be expected to outperform in down markets, and so will be more likely to screen on numbers such as downside capture or Sortino ratio, for example. When screening for growth managers, we like to look at managers who have been following their style even when it was out of fashion. So we might look further back at performance in the run-up to the financial crisis, and that's an example when the macro environment was very different. The one key advantage of screening is that you can find managers who may not have funds for sale in the UK or in Europe, but still have funds with impressive track records that may only be eligible, say, for US investors. So our ability to set up customized managed accounts means that we don't need to wait for these managers to launch products in the UK or Europe before we partner with them. We think this is a pretty significant edge, and that gives us the ability to partner with talented investors earlier than some of our peers. And we've had great success in this regard with some of the managers currently in our global equity fund. Of course, the risk with screening is that it tends to throw up funds that have already performed exceptionally well. And we all know that past performance necessarily guarantee future returns. So the other way really to narrow the universe is through utilizing our existing network. So our investment team have a wealth of experience, and through that time, we've developed a good sense of the leading specialists within each asset class. Of course, each of us has our favorites, and on an individual level, we're all susceptible to personal behavioral biases. But that's why our whole approach to manager selection and asset allocation in general is team-based. Whenever we make a decision to partner with a manager, the whole team sit down and discuss the relative merits with known peers, and we really bring our experience to bear. And then finally we arrive at a collective decision. Also, I mean, this is really a feature of how we work generally, and particularly when we're in the office. Again, it seems like an age ago, but we speak regularly and exchange views on individuals and firms, who we've met recently, and that in itself is a great way to focus our research. So really, I think that's a good summary of how we tackle this challenging issue, really. But as always, we're very engaged. We're always happy to discuss things further as required. So with that, I think I'll bring my answer to an end and hand over back to the rest of the team.
Thank you, Richard and Robert. To hear the role research plays in making the right investment decisions is incredibly insightful. That is why it is so important to partner with the right investment managers. So let's delve a little bit deeper and look at one of those styles in a little bit more detail. Natalie, is quality the only answer for building resilience into an investment process and portfolios?
Thank you, Kapil. Building resilience in a portfolio is not one-dimensional. Yes, quality businesses with robust profitability, attractive return on equity, pristine balance sheets, strong brands, and pricing power provide protection, especially during periods of low economic growth. And Robert actually alluded to this earlier. But these defensive qualities often come with a price, with quality counters sometimes trading at a premium to the intrinsic values. With the MSCI World Index, Quality Index, comprising more and more of IT stocks in particular, a lot of these quality counters have become amongst the pandemic winners in e-commerce and online, which has now pushed their valuations up even further. This chart here, as an example, highlights the tremendous growth achieved by well-known tech and consumer services companies over the last few years. As can be seen, their total market capitalization has risen from $1 trillion in 2012 to nearly $8 trillion at the end of March 2021, a nearly 800% increase in less than a decade. So with the valuations of some of these quality counters such as Apple, Microsoft, and Facebook becoming stretched, it is actually these counters that are at the biggest risk of a sell-off, especially if, or should I rather say when, real and nominal yields start to rise in the future. We have already started to see some of this rotation from some of these pandemic winners to those sectors which have suffered most from lockdowns and the sudden halt in activity. And this trend will likely continue as the economic recovery gets momentum. So yes, quality counters can provide resilience because of the nature of their business models, the inelastic goods and services they provide, and their strong return on invested capital metrics. But as always, the price you pay for an asset, no matter the quality, is still a critical consideration, and some of the quality counters may not provide the resilience as expected. On this point of resilience, what is of interest to note is that quality is not the only style that provides protection in periods of market turmoil. Value stocks have actually outperformed the market during some historic bear markets too. This slide here, for example, plots the performance of value companies against the S&P 500 during 4 of the last 6 bear markets. The x-axis highlights the beginning of the market sell-off to the point of the market recovery when the S&P was right above water again. What you can clearly see in these graphs is that value stocks, as represented by the blue line, outperformed the market, or in the case of the Gulf War, provided significant protection during the initial market sell-off. Now, I'm not saying that value stocks will always outperform or be resilient, because during the last 2 crises, value has underperformed significantly. Instead, I'm trying to put these 2 most recent crises in context, because in very different economic circumstances, value stocks have clearly provided resilience. So the notion that value companies are poor quality companies that will perform poorly in bear markets is not always the case, and is very important to remember that point.
That is an interesting point. You are right. Recency bias may lead people to think that value stocks do not provide resilience during bear markets. So clearly, investment styles perform differently in different market circumstances. Neither quality or value should be used as a one-stop shop solution. How do you go about building resilience into an investment process and portfolios?
Yes, you're correct, Kapil. In order to ensure resilience and increase the probability of our portfolios achieving their return targets over time, we look beyond one equity style or asset class to try and build portfolios that not only participate in rising markets, but also provide protection should things turn for the worst and there is a sell-off in risk assets across the board. So how do we go about doing this? The answer is quite simple. Through the consistent application of our outcomes-based investment philosophy that adopts true international diversification and unrivaled flexibility to not only seek returns, but also eliminate unnecessary risk where possible. This chart here, as an example, highlights the multi-layer diversification we use within our portfolios. We look beyond traditional asset classes like bonds, property, cash, and equity to areas such as alternatives, credit, convertibles, real assets such as infrastructure, and of course, precious metals. Richard actually mentioned earlier that we look at 15 asset classes in total. We diversify further across different regions and sizes. Within equity, we follow a blended style approach across value, growth, and quality factors. And then finally, we also look to diversify across currencies and investment strategies. Ultimately, we believe there are many levers to pull to enhance the risk-return outcomes of our portfolios, to make the investment journey more palatable for our clients, and also to seek additional returns in this low-yielding environment.
So, diversification is key to your process. Could you dig deeper into a few of these concepts? How do you look at diversification in terms of asset allocation, investment styles, and managers, as an example?
Kapil, from an asset allocation perspective, we look to own the right combination of assets so that the overall portfolio behaves positively across a wide range of macroeconomic scenarios. Here, it is very important to increase the opportunity set of asset classes so as to increase the diversification benefit, as represented by this blue bar on this graph, and hence reduce the risk reduction benefit of the portfolio as much as possible without sacrificing on the portfolio's return objective. The higher the diversification benefit, the greater the resilience, and hence the easier it will be for our clients to stick with their investment journey and ultimately reach the investment outcome that they're wanting to reach. From an investment style perspective, quality, value, and growth investment styles have been shown to generate excess returns over time, but tend to outperform during different market circumstances, as I touched on briefly earlier. As shown by this particular graph, our research shows that blending these complementary investment styles, being quality, growth, and value, is the best way to not only generate excess returns, but also minimize risk and make the investment journey more palatable for our clients. And this is clearly illustrated by this red line on this graph. Furthermore, the factors driving each of these styles are sufficiently distinct and independent that they provide additional diversifications for our portfolios too. Now, in terms of how best to access these styles and asset classes, we look to partner with the specialist asset managers per asset class, per investment style, and per strategy, whether it be active, passive, or systematic. In today's diverse marketplace, we believe that there is no single asset manager that can adequately access the variety of opportunities on offer. And that is why we look to diversify across the best managers we can find across the globe. And Robert touched on just how we look to do that. In addition to diversification, we adopt a strong risk management process and use proprietary risk analysis tools to consider the impact various macroeconomic scenarios have on our portfolio returns, as well as how active allocation positions contribute to intended and as well as unintended risks. Ultimately, over time, returns are rewarded for taking on risk, but our strong risk management process will seek to identify and reduce and hopefully eliminate exposure to all those unintended risks. And the reason why we do that is because we want to generate robust returns for our clients and limit volatility where possible. So, Kapil, to answer your question, is quality the only answer for building resilience into an investment process and investment portfolios? We believe the answer is no. A robust risk management process and true diversification across risk and defensive assets, equity styles, asset managers, currencies, and regions is the best way to mitigate risks and enhance returns over time. With market volatility expected as we head towards and then through the economic boom that is sure to come, This philosophy and process couldn't be more appropriate now.
Thank you, Natalie. That was deeply enlightening. I mean, I'm definitely stuck on your notion that diversification is the right conversation to be having, and the question that we asked at the beginning is probably the wrong one. Next up is a short video about MGIM, how it started and how this unique division has evolved in the last couple of decades. After the video, Ray will be chatting about advice noise, bias, and blind spots.
Momentum Global Investment Management was established in the UK as a specialist global investment manager. The firm is part of Momentum Metropolitan Holdings Limited, a large South African insurance and investment business listed on the Johannesburg Stock Exchange. We are deliberately different. We have developed a unique investment philosophy that prioritizes the prospect of you achieving your own unique investment goals. This is supported by a tried and tested focused investment process. Together, we call this the Momentum Outcome-Based Investing Approach. We focus on designing, building, and managing outcome-based investment solutions and on providing investment consulting services.
We started Momentum Global Investment Management as far back as 1998. And the interesting thing is it was started a year after South Africa relaxed exchange controls. And Momentum responded really quickly. In fact, in a year's time, we launched this business in order to respond and to deliver solutions for South Africans' offshore investment requirements. Today, we manage well in excess of $5 billion in global international solutions. In fact, in the last 5 years, we've also started to deliver investment consulting solutions to defined benefit schemes in the United Kingdom. And today, we advise on 40 billion sterling of assets. London is by far the most international of global financial centers in the world.
I've been in the investment industry for almost 50 years, and there's one big thing I've learned in that period of time is that you have to be at the center of the industry, and London is that very center globally.
Behind me is the Bank of England that has been the rock of the financial center for many, many years.
Momentum Investments has an outcome-based investing philosophy. This means that the investment team in London use a diverse range of asset classes to create portfolios with a single focus to help clients achieve their goals. In terms of making the journey comfortable, I think there are two angles to that. The first one is building portfolios that are robust and ride out market storms as well as they possibly can. Still, there's an element of people's anticipations and expectations. We want to manage expectations ahead of time to help people understand where markets are bad, what that means, where markets are good, what that means. That's why we focus a lot as a business on getting out there, meeting our clients, and being open, communicative, and transparent. As the Global Fund Specialist, I represent Momentum Global Investments in South Africa. I work very closely with financial advisors, bringing the global expertise in outcome-based investing to their doorsteps. I work closely with the investment team in the UK, and through this collaboration, I can provide asset class and economic views, fund insights, and support to advisors, and increase the awareness of our offshore solutions right here in South Africa. Together, we can help their clients along their offshore investment journey.
Diversifying beyond your home market, whether it's South Africa or frankly the UK or even the United States, is essential. So you've got to open up the whole world to your opportunity set. And of course, investing outside South Africa, you invest in economies that are at different stages of the cycle, much bigger economies, much deeper economies, lots of different industries.
We focus this business very much on delivering solutions to a larger expat community. In fact, we have clients across 6 continents in our solutions.
We operate in regions like Asia, Hong Kong, Singapore, Shanghai, Beijing, Tokyo, parts of Southeast Asia, Middle East, Latin America, Europe, offering services to IFAs who in turn work with expats. And we have become the go-to place for multi-asset risk profile solutions for those advisors.
Research is imperative to the business. The investment team tries to be ahead of the curve, looking forward as far as they can into the future. Now, they don't have a crystal ball. Nobody does. But what they do have is a sound process that looks at fundamentals. The team looks at the asset classes that they think are cheap today and will reward investors going forward, and stay away from the ones that they think are expensive and they think will detract from performance.
When we look at employing and attracting staff into this business, the question is, of course, one of culture, right? What is your integrity? What is your can-do attitude? And we are lucky to have a group of people here that are incredibly well qualified, great experience. So just to give you an idea, we've got 3 CAs, 6 CFAs, 8 student CFAs, 5 actuaries. I mean, that's half the staff are really professionally qualified.
We want different views. We want people at ease in being able to challenge all of us. If you've got that terrific vibe where everybody's used to working together, enjoys working together, it's an open culture where people can speak their minds without being sort of trodden on by senior people, that's very, very important. So I think that openness is very important to encourage that debate and challenging of ideas.
Momentum Global Investment Management has the best of both worlds. In South Africa, the team have behind them a very large and very supportive parent company in the form of Momentum Metropolitan Holdings. Yet they are structured like a boutique in the City of London, focused on delivering investment outcomes for our clients. So MGIM has the best of both worlds, the core proper support, but also a focus, nimbleness and agility that comes from being a relatively small business.
For more information about Momentum Global Investment Management, please contact Natalie Harrison at natalie.harrison@momentum.co.za. Visit our website at momentum.co.uk or speak to your Momentum consultant.
Greg Davis is the head of behavioral science at Oxford Risk in the UK. And next to me here in studio is Paul Nixon, who is the head of behavioral finance at Momentum Investments here in South Africa. Greg, this is the first of its research on noise in investment advice. So the question is, how noisy is your investment advice? We're going to need some context here on this one to clear things up. So perhaps let's start with the obvious question. What's noise and why should we care?
Thanks. Yeah, this is something I'm very excited about because it coincides with the launch of Daniel Kahneman's new book on noise. Now, Daniel Kahneman is the father of behavioral economics. He won the Nobel Prize for Economics in 2002. And what you will have seen is that over the last 20 years, a lot of the behavioral research has been around bias rather than noise. And if you look at those targets on screen, you can see if we're trying to make a decision and our decisions are consistent and they're accurate, there's always going to be a little bit of variation. So that target there where they're all clustered around the bullseye, there's a little bit of variation, but they're tightly clustered and our decisions are hitting the target roughly time after time. If we're biased, like in the bottom left there, our decisions are tightly clustered in the sense that we're doing the same thing time after time, but we're off target. That's bias, and that's where a lot of the historical focus has been. The issue here is noise. We can find a situation where our decisions on average are accurate, but that doesn't matter because if every one of those little crosses on the target is an individual client and they're each getting the answer that's wrong for them, it doesn't matter to them as individuals whether on accurate the system is correct because each of them is getting the wrong answer. And that is noise. That's what we need to be concerned about when we're doing things like giving advice to people. Are they getting the answers that are consistent and suitable for their needs?
Okay, that makes sense. But let's zoom in a bit more on financial advice here. How do we even start to come to grips with how much noise there is?
Yeah, so if we look at the next slide there with the triangle, when we're thinking about financial advice, there are really 3 layers to that triangle that we need to be concerned about if you're going to give someone the right advice. At the top is someone's willingness to take risk, their risk tolerance, the degree to which they are willing to trade off risk in return for their long-term outcomes. It's a personality trait. It's something that we can measure accurately using psychometric tools, and it's the anchoring point for good advice. But it's not everything. The second layer is, how do I adjust the right level of risk for you to take into account your financial ability to take risk? This is about your financial circumstances now. Do you have a big mortgage? How many kids do you have? Do you have a lot of spending needs? What is the size of your portfolio? Every one of these things influences the right answer for you to take advice. And then right at the bottom of the pyramid is your emotional ability to withstand the journey. Are you someone who's likely to be anxious as the markets go up and down, and therefore even if you're in the right portfolio for you, you're going to start making mistakes. You're going to get nervous, you're going to get anxious, and you're going to jump out at the bottom or make costly, emotionally driven decisions along the way. Now, all three parts of these layers are very important in establishing the right answer. So what we have done in order to investigate noise is we've gone to hundreds of advisors, South African advisors, and given them case studies, individual clients where we say, here is pretty much everything you need to know to establish the right answer for those clients. So there's information about every layer of that pyramid. Essentially, they get a little biography of the client, they get a description of the financial circumstances of the client, they get evidence from a psychometric test about what the risk tolerance of that client is. And then we've asked these advisors, so now you've got all the information you need, what do you think is the right answer for each of those clients? And then we look at the data that comes back and we see how noisy is it.
I think we can all agree that we need at least some level of consistency when advising clients. What's your approach to measuring this, Greg? Can you tell us a bit about the research design?
So let's look at some of that data. What you see here is the risk level that all these advisors suggested was appropriate for each of these clients. Now, it's very typical in financial advice to put clients on a scale, maybe a 5-point scale or here a 7-point scale, how much risk is suitable for this client to have given everything I know about their financial circumstances and the three layers of that pyramid. And the design here was very deliberate. So, for example, client 1 and client 4 are exactly the same in financial circumstances, except that they have a difference in risk tolerance. So the way we designed this survey enables us to tease out what is influencing the advisor's answers here. But the fundamental takeaway from this slide is you can see it doesn't matter which client we're talking about, which case study we've given to advisors. The answers that come back are all over the place. Each client has suggested risk levels, everything from very low to very high. And that is the noise in the system. That tells us that there's an awful lot of stuff going on that isn't about the client. It's about the advisor or about the surrounding circumstances. And that means that a given client visiting an advisor 1 month or the next month, for the same client, they may get a different answer. Or it means that a client going to 5 different advisors may get 5 different answers, regardless of the fact that their situation is exactly the same from time to time. Now, the next thing we want to know is, okay, so we've established the risk level for a client, and that's noisy. But you might think that, well, once we've established that a client is risk level 3, then all advisors should be giving risk level 3 roughly the same answer, right? They should be getting the same riskiness of the portfolio. So we also investigated once the advisor has given the client an actual risk level, are they giving them an investment solution that matches that? And on that next slide, you can see this. Now there is good news here. As we move from risk level 1 to risk level 7, you can see that the equity allocation, the proportion of risky assets in that portfolio, goes up systematically from low risk to high risk. And that's exactly as we should see it. However, even here, there's a lot of noise in this system. So let's just look, for example, at those clients that the advisor said, you are risk profile 3. And here we see the bulk of clients in risk profile 3, their equity allocation varies between 30% and 50%. And at the extremes, some risk profile 3 clients are getting as low as 15% equity, and some are getting as high as 75% equity. So this is an enormous variation of the actual answers, the investment portfolios that are given to clients where the advisors have already decided that they are a risk level 3. And on risk level 6, for example, you can see the allocations go everywhere from 15% all the way up to nearly 100% for risk profile 6. So again, an awful lot of noise in that system. And when we put these two bits together, so is there noise in assessing the risk level of the client and noise in assessing what solution I give to that risk level, on the next slide, you can see that every one of our 6 clients was effectively, by different advisors, offered an equity allocation that went all the way from nearly 0% to 100% for the same set of client circumstances. And that is the noise. That is the stuff that is extremely concerning, because it tells us that me as a client, I cannot expect to get a stable and a consistent answer from one advisor to the next, or from one advisor at one point in time to another point in time.
Fascinating, Greg. And I certainly agree that we have some work to do, and even agreeing perhaps on what some of these things mean, which could explain some of this noise. Can you perhaps tell us where the noise is coming from?
Yeah, we were, because of the structure of the survey, we were able to tease out some of this. And if you go to the next slide, I'll just point out a few things here. So the first thing there is a certain amount of the noise is coming from where it should. A certain amount of that noise is coming from the circumstances of the client. So if one client is different to another, they should get a different answer. But the characteristics of the investor are only explaining 28% of the variation of the answers of the recommendations that were given. So that is much lower than we would hope for. The jump then from 28% to the next bar, which is 32%, this is variation that is explained by differences in the advisor. So I think, that's quite comforting. It's not very big, but what it tells us is there's a small degree to which, if the advisor is more risk-taking, then that's leaking out onto their client recommendations. So advisors who are themselves more risk-tolerant tend to give clients higher risk portfolios, even if perhaps that's not in the interest of the client. And then the next big jump, up to 54%, these are subjective judgments of the advisor about the client's risk capacity, about the bits of that pyramid, that triangle, and how to put it all together. Now, it is entirely appropriate that advisors are making judgments about the aspects of those triangles, the risk capacity, the risk willingness, etc. The trouble is that particular chunk of variation is coming from advisor judgment, but doesn't seem to be directly related to the characteristics of the investor. And what that tells us is that advisors are using different models, different mental models on how to weight the different bits of information they're given from a client. They don't seem to be using a consistent framework of how to combine the various bits of that pyramid of the things that they need to consider. And then at the top end, what we're left with is 44% of the variation is unexplained by anything, by any piece of data that we input into the system. And that is just pure noise. That tells us that there's just variation of advisors doing different things in a very, very idiosyncratic way.
Thanks, Greg. Now we're going to look at a little bit of what's going on between our ears when we make investment decisions. We all know that we shouldn't drive under the influence of alcohol, but what happens when we make investment decisions under the influence of cortisol? Paul, talk a little about the power of chemicals as a driver of behavior.
Right, thanks, Ray. Let me put you on the spot maybe as we start this with a question, right? So can you remember the first time that you fell in love?
I think so.
All right, so the interesting thing about that is as you even started to recollect, you got a bit of a smile on your face, right? So that actually happens because your brain is releasing a little bit of dopamine when you recollect that experience. And that just really shows us how powerful chemicals are when we make investment decisions, or when we make decisions in general. And that obviously translates to our world of finance as well, which is quite an emotional play as well. So in actual fact, when a study was conducted about on people who were in love, they found that people who were in love their brain experiences a serotonin deficit. Now serotonin is our natural mood stabilizer, and that obviously kind of explains the dramatic mood swings that we sometimes see. But what's also happening is that your brain is setting you up for a hit of dopamine. Now dopamine your brain is using to elicit the correct behavior from you. So dopamine is a powerful reward chemical, and just to give you some context of how powerful that is, I mean, cocaine addicts, for example, what they're after is a hit of dopamine. So as we said, your brain is trying to get you to do the right thing, and the right thing in this case, of course, when you're in love, is procreation, right? So it's passing on your genes. So the hopeless romantics, as human beings, we're very, very good at dressing this kind of stuff up in narratives that the hopeless romantics amongst us might call fate or destiny. But that's pretty much what's happening, right? Your brain is trying to get you to do something. So I think, if we look at those as happiness chemicals being serotonin and dopamine, the other side of that equation, of course, is stress chemicals being cortisol, right? And we're going to talk a little bit about that now. So So as it turns out, our genes hold very valuable information about our risk preferences. So a study conducted showed that about 100,000 people, or in 100,000 people, that there are 9 areas of the human genome that are related to the personality trait called neuroticism, which of course correlates to anxiety. Now, people who are anxious experience or interpret a greater number of situations as a threat, for example. So what you can see on your screens there is what's happening in your brain as this happens. So your limbic system, which is your center for fear and risk, is passing on chemicals via your pituitary glands to your adrenal glands, which sits just above your kidneys, and that's going to elicit this cascade stress response. So you're going to get an increased elevated heart rate and an increased blood sugar and blood pressure. But the most important thing here is that a message is going to be sent back to your brain that is going to influence your cognition. So that's the way you're going to perceive the situation and how you're going to perceive risk. And this came out in a study done by the Wharton Business School very clearly that showed that when people have cortisol in their systems, they're far more likely to act on gut instinct, right? So they're far more likely to bypass their rational thinking center and go straight to the gut instinct, which is important in terms of our investment decisions.
And I suppose COVID-19 is a great example of an event that caused a lot of anxiety in society. So what did we learn from this, Paul?
Yeah, so there was a lot of activity happening in markets at that time, right? So we saw about 1.5 billion rand switched, from March till December 2020, and obviously COVID hit in March, or the market impact at least hit in March. We saw markets dipping from 57,000 points to 37,000 points pretty quickly. And what happened there was 100 million rand of investors' money was lost, and it was lost from people making switch decisions or intervening in their portfolio or cancelling or rather exiting their investment. So we saw that the anxious archetype, and we're going to talk about the archetype shortly, destroyed the most amount of value. So it's people with that anxiety trait destroyed the most amount of value. And of course what happens here, and we're going to talk about the details, but the anxious investors, for example, need a lot of confidence, or they need markets to give them a lot of confidence to get back into things. And of course what's happened by that stage is markets have already recovered. So we can see just some other interesting stats here. On average, 6.5% of people's portfolio values were destroyed if they made switch decisions last year. And if you switched, for example, towards the latter part of last year after markets had recovered, you were destroying about 19.44% of your portfolio value per switch. And that's obviously because you were sitting on the sidelines as markets had already recovered.
Wow, 1.5 billion switched and 100 million rand lost. I mean, Greg, you've done a lot of work on something you call market composure. What exactly is this, and how would you measure it?
So composure is very closely related to that psychological trait that Paul mentioned of neuroticism. We prefer to call it composure because it's much easier to go to an investor and say you have low composure than to say you're a neurotic individual. But essentially, it's a part of our personality. Some people more naturally have higher composure, which means they have it's easier for them to keep a focus on the long term and not to get too emotionally involved in the ups and downs of the here and now. Whereas low composure people are those that are very emotionally involved in the present. They feel every bump in the road as the markets go up and down. And when that happens, that leads towards a higher emotional component in our decision making. It leads to much more frequent decision making. And often, as Paul has said, that can be extremely costly because you're reacting to very short-term signals. Whereas as an investor, what we should do, if we're being a good investor, is we should be thinking, how do I set up my portfolio to benefit from the long-term movement of the markets?
This time last year, people were very worried about the market, and some people even switched out of the market. And today, some people are too scared to get into the market because they think it's running hot. We've talked a little about behavior patterns today, and it seems that at certain times, we're more likely to behave in a certain way. And that's just part of our DNA. We're just wired that way. But there are at least two human beings involved when advice is given. We have a client, and perhaps their partner, and also the advisor. Paul, let's start off with you and the work you've done on client behavior. Can you quickly take us through the high-level behavior patterns you found on the Momentum Wealth platform and perhaps a big blind spot that each may have?
Yeah, thanks, Ray. So we use some machine learning algorithms to help us just process a massive amount of data, right? So So we had a look at people or investors' decisions and preferences and how these preferences were changing as their investment values were changing. Now, we saw 5 distinct behavior patterns here that we're going to talk quickly about now. So the first one was called, we called the anxious investor. So these are the investors that Greg was talking about, in respect of market composure. So at the first sign of any troubles, they're running for the hills, basically. So the biggest blind spot that they have is definitely loss aversion, right? They're perceiving a situation as a threat, and they're trying to intervene or do something to get away from that threat, right? And there's also, there's a strong anxiety kind of trait to this, right? The next one was the assertive investor, right? So assertive investors are looking for the next big investment idea, right? They're looking at cryptocurrency, at private equity, for example. They're looking for the next big investment fad or idea, and they're looking to chase investments with very, very high performance levels, right? So a very big blind spot here is obviously overconfidence. So we have a trait or a distinct or a tendency as investors, for example, to overestimate our abilities to judge something's, an investment's trajectory or if it's going to increase in value. And the third one was the avoiders. And these are people who just don't like taking much risk at all, right? They kind of sit towards or very, very near to the sidelines, and they're very, very even scared to dip their toes into markets. So they sit or they get stuck in assets that perform or that are quite safe and stable, if that makes sense. And of course, the biggest blind spot here is definitely inflation risk. So what happens with these investors is they don't expose their wealth to risky assets much, which means that inflation becomes quite a big challenge to them. Of course, there is also an element of loss aversion here, which would be prevalent. And then we have market timers. So the market timers, they don't like being different from everyone else, right? So they like being part of the herd or the tribe. And we see this behavior where these investors were, as markets were increasing, were really chasing past performance, and as markets were decreasing, they were really, de-risking their portfolios quite aggressively to try and get away from the risk levels. So the blind spot here is herd behavior, right? So it's these investors who like to be doing what other people are doing, basically. And then the last one are the contrarians, right? And this was actually a very interesting archetype. So these people were almost your typical Warren Buffett investor who are fearful when others are greedy and greedy when others are fearful. And we thought this was very interesting because it might have provided a good template here for investing, right? So we saw with contrarians that they were the only archetype to generate a positive behavior tax, right? So they added a tiny little bit of value by switching. Of course, however, on close investigation, we actually saw that this was also the most unstable archetype. So Joe Soap, for example, didn't manage to stay a contrarian in period 1, 2, 3, and 4. It was just all over the place. So it definitely seemed to be a very, very strong element of luck in landing in the contrarian archetype. So it didn't really represent a real person, if that makes sense. And this is pretty much what we found, or the general behavior patterns we found with investors.
And I suppose for that contrarian is that lack of consistency and knowing, you're not an expert, are you, in the end of the day? And Greg, but what about advisors? While they may have their own behavior patterns when investing for themselves, they may very well have a different pattern of behavior or blind spots when they advise on clients' money. And what did you find in your study on the advisor themselves in terms of noise?
Yeah, that's true. So we applied some very similar statistical techniques that Paul has applied to the clients. But we applied it to the data that we have on the study we looked at and the noise. And we've already seen there's a lot of noise in advisor recommendations. But what we're looking for is to say, do certain advisors have tendencies or proclivities to err in a particular direction or to follow, for their advice to follow a certain pattern? And we found 4 clear groups. So the first of these is there's a big bunch of advisors who tend to be slightly more cautious. They, regardless of what the client in front of them, they will tend to offer that client a slightly lower risk level. And these advisors themselves, we see, tend to be those who have slightly lower composure. So that makes sense. To some extent, it's the advisor's personality bleeding over into the advice that they give to clients. There's a group that's unsure. Fortunately, a relatively small group here. These are less confident advisors. Their advice tends to be the noisiest. And interestingly, it's the noisiest largely because they tend to give the same answer to every client regardless of what their client situations are. So these are the guys who are unsure, and therefore they go, oh, well, I'm just going to give everyone the same safe solution. We have those advisors who are more risk tolerance focused. So their advice is definitely more responsive to the client's needs, as we would expect, and is typically they're giving higher risk portfolios to more risk tolerant clients and lower risk portfolios to less risk tolerant clients. And that's as it should be, although even in this group, we do see that there's noise around the advice they give. And then lastly, we see the more relaxed advisors. These are the ones who themselves tend to be higher risk tolerance, higher composure advisors. And again, that is bleeding through into the advice they give to the clients. So they tend to be recommending to their clients a slightly higher risk than other advisors would be, regardless of the client that's in front of them. So, I mean, these are tendencies. I stress that this isn't to say that every advisor in one of these archetypes is doing exactly that for all clients. But these advisors tend to display this kind of tendency to give either slightly less risk to the client in front of them, or slightly more risk to the client in front of them, or in the unsure category, it's pretty much the same answer regardless of the client in front of them.
So you're saying, Greg, that we should be thinking about how we match advisors and clients in order to counteract those kind of blind spots?
Yeah, no, that's a very interesting case in point, because that is useful. If you want to help clients to be good investors, it is really important that you give them emotional comfort through the markets. And one of the sources of emotional comfort is to have an advisor that is matched to you. The problem here is that advisors come from a much smaller range of personality types than their clients. So, for example, most advisors tend to be higher risk tolerance, higher composure, higher confidence when it comes to financial decision making than their clients. So many advisors are just going to have to serve clients that are not like them. We can't just do a one-for-one match, because advisors as a group are a subset of the broad client population that they serve.
Interesting, Greg. So you're saying that financial advisors come from a narrower set of personality types compared to, obviously, the personality types that we have in society. So could this be a problem? And if it is a problem, how much of a problem is it?
Well, it shouldn't be a problem as long as advisors are aware of this. And they're using their expertise to give each client the answer, the recommendation that is suitable for their needs, their financial circumstances, their financial personality, and their risk appetites. And the advisors are then not letting their own personality and risk preferences influence the situation.
But from these archetypes, it does seem like advisors are letting their own blind spot impact on clients.
Yeah, and that does seem to be true. I mean, there is this evidence here that says advisors' characteristics are influencing the recommendation that they give to clients in a way that might not be entirely appropriate, but also that advisors, when they consider all the client situations, when they're combining the psychological risk tolerance, all the aspects of the balance sheet, whether you've got a mortgage, all these bits, that advisors aren't necessarily putting them together in a consistent way, and that's where the noise comes from. So there are definitely circumstances where we could get a very poor match between client and advisor types.
And Greg, the final word is yours. Where do we go from here to address everything we've discussed? I mean, for me as a client, do I now go to my advisor and check what archetype he or she is in order to decide whether the advice that I'm getting is appropriate? And we've seen such a digital transformation with COVID-19. How is this going to affect advice in general? Can a machine check our emotions before we make an investment decision, for example?
So I think your focus there on digital is exactly right. When we're looking at advice, there are so many moving parts to keep track of, so many bits of people's financial circumstances that all have to be combined in a consistent way. And this is the sort of stuff that humans are bad at, juggling lots of pieces of data and combining them into an answer, etc. So this is where technology can definitely help us. The use of technology in order to do some of the profiling, to introduce more objectivity into that process, and the use of technology to do all of the heavy lifting, the combining of this stuff in a consistent framework. That is very useful, and that provides a guidance system to advisors to reduce noise and help make them consistent. But one thing I would say is this is absolutely not about the machine providing the answer, right? The advice process needs to still be human-led. just knowing what the circumstances are, just having the guidance of what the right answer should look like is not enough to help people stick with that answer. That needs human conversations, it needs empathy, it needs discussions of values. So in our view, the real solution here is better use of technology, decision support tools, decision prosthetics, in order to make the advisors the best version of themselves they can be day to day, and to make them more consistent and reduce that noise.
Absolutely, I couldn't agree, and I couldn't agree more. I see financial advisors as a coach, someone who actually understands me, the human, and I don't think that a machine could do that for me. So thank you very much, Greg and Paul. That was very insightful. Those were such interesting insights, actually. Our annual think tank conference was designed to give our intermediary and wealth management clients substantive investment thinking and ideas, rather than a more typical product or sales-driven event. Originally designed to provide our South African clients with a global, independent perspective on investment matters, Think Tank has gone from strength to strength, and delegates now attend all over the world, making Think Tank a truly global event. Our 20th event is taking place in September, actually, and we will send you all invitations in the next month or so. So please watch out for this. And next is a little short video about this exciting event, and we hope to see you there in September.
Think Tank is an event designed exclusively for investment professionals and institutional investors. It is a true collaboration of investment specialists providing independent, non-conflicted views and opinions, achieved by avoiding sponsorship and other financial promotions, and with the aim of sharing knowledge and ideas, giving Think Tank an excellent reputation within the investment industry. Originally designed to provide our South African clients with a global, independent perspective on investment matters, Think Tank has gone from strength to strength, and delegates now attend from all over the world, making Think Tank a truly global event. The combination of independent thinking, thought leadership, idea generation, and depth of analysis supports delegates in their quest to achieve their own clients' goals. The first conference was held in 2002 in the heart of the City of London, the world's leading financial centre, and has been held there for the last 20 years, with the exceptions of 2007, when we chose New York, and 2010, when we ventured to Hong Kong. In pandemic-ravaged 2020, we held our first virtual conference, which was a huge success with over 1,000 delegates online. Think Tank aims to cover topical events in the global economy and financial markets, with a particular theme each year based around the most important issues facing investors, as well as exploring longer-term perspectives on investment opportunities globally. Each year, we invite a range of outstanding and experienced speakers from around the world, including strategists, economists, investment managers and analysts from global investment banks and specialist asset management firms. We carefully select the topic for each speaker to make sure we offer an unrivaled variety and depth of analysis and strategic thinking. Contact your business consultant today or reach out to Natalie Harrison, your global fund specialist, to book your seat for Think Tank 2021.
Thank you everyone for joining us for our virtual Global Matters conference. We hope you have enjoyed all the presentations and will join us again next year. Remember to visit our download section, and if you have any questions, one of our distribution consultants will gladly get in contact with you afterwards. We hope you are all as excited as we are about this journey into a future that is alive with possibilities in our truly brave new world.
Kapil, I don't know about you, but this has been quite an experience. I hope that you've enjoyed this morning as much as we have, but most importantly, I hope that we have created value for you this morning. After this webinar, the videos will be available on the Global Matters portal and our events page on momentum.co.za, and also on the Global Matters WhatsApp bot. Thank you for trusting us with your clients' hard-earned money. And until next time, goodbye.
Goodbye.